So today I want to take a bit more of almost like a philosophical approach and look at, I think, something that we need to just address here a bit more publicly. We talk about this to our clients all the time, but it has to do with, what if something like a cryptocurrency becomes at least at the margin, an alternative at times to, let's say, something like the bond market. And so I want to make sure everyone kind of understands where we come from. We certainly respect everyone's opinion, bullish or bearish, and all the arguments, and we look at them all the time on where, thoughts on the cryptocurrencies, the Bitcoins, the Ethereums of the world. So we are certainly always open to any feedback on that as well, and would love to hear from you. Where we stand right now is that we're telling people anywhere between 1% and 5% of allocation to something like a Bitcoin in a portfolio within the bigger context makes sense. So it's a longer term investment vehicle. We're not looking to trade this right now. That's our sort of house view right now. Having said that, I wanted to bring something up, and we just earlier this week heard from this gentleman here in the bottom right hand corner, Ray Dalio. He's the CEO and I guess he's probably the original founder of Bridgewater Associates. It's a major hedge fund, and maybe he's no longer CEO either. Maybe he's on the board. I don't know. I don't want to give him an official title since I don't know. Big hedge fund guy is the bottom line, and he sort of in passing towards at the end of an interview said that he would actually prefer to own a Bitcoin versus owning a bond. And, we've been of that sort of thought process, going down that thought process for quite some time now. But since this is now becoming a more mainstream news to talk about, I thought it's only appropriate to give you a bit of an idea of what this potentially could mean through the lens of, again, right now, just a philosophical idea and really something we need to think about and go through. For the record, and I just brought a chart along of the U.S. bond market, or the global bond market, actually bond market. This chart's a couple of years old, so the bond market's certainly a different size now. But and this is corporate bonds. It was roughly 40 or so a trillion. The bond market is a lot smaller, by the way. The stock market is much smaller than the bond market. Meaning, what I'm trying to tell you is that the bond market is a very big market and a very important market, certainly for people at home, but quite frankly, mostly for corporations, for institutional investors, what we call them. And so if you think about this, if we are in a situation, and we are, where, and I'm going to bring up live here a quick chart of the US 10-year yield, and I'm going to make this a chart that's a bit easier to view through a lens of a long-term view. We essentially had the U.S. 10-year yield peak out in, I think 1981 was the year, and we are now essentially many years later where maybe we've seen a low in the yield, meaning we've had a bull market in bonds for many years, and meaning a bear market in bond yields. But that may be about to change. But I think before we see a major change in bond yields going a lot higher, the odds are quite high that we have more of a trading range, meaning bonds aren't going to be that interesting. They're not going to yield a lot, so they're probably not going to be a hugely attractive point to buy. But even if you wanted to kind of be on the short side of bonds and expect bond yields to go higher, there's probably limitations to which that can happen for the time being. So if bonds are no longer that interesting, certainly from a yield perspective, which they haven't for a while, and central banks make this clear, at some point, of course, central banks will be forced their hand and they have to raise rates, but they don't want to do that as much as possible, prevent that actually, because of the amount of debt we have. And of course, if they were to raise rates, then they have to higher rates at which they can refinance their bonds, and they don't want that. Makes sense. So from an institutional investor's perspective, why not consider something like a Bitcoin? And again, I'm sure everyone's got different opinions, and we are aware of most of those thought processes, which I think they're all great. Why not start looking at something like a Bitcoin or even Ethereum and other tokens and other cryptocurrencies out there as something that is going to take place, maybe not so much as a replacement of equity portfolio, stock portfolio, but maybe a part of the bond portfolio. And that seems kind of very counterintuitive, considering fixed income is supposed to be very steady, low volatility. Why would you replace that with a Bitcoin? But these are arguments we're hearing more and more and more. And so, the reason I'm bringing this up is because I think we need to start respecting cryptocurrency, for better or for worse, as something that is an alternative asset class or another asset class. Very much like hedge funds were being poo-pooed for many years before everyone started investing in them, and there's cycles in those. We think it's going to be very similar here. But we think, the more institutional money comes into this space, the more interesting this gets, the more liquidity goes up, the more general just intellectual capital, even though there's a lot of intellectual capital going into this space. So if you want to be long something like a Bitcoin, a small allocation, 5%, again, this is not a recommendation, it's just what we are seeing here being done, and we think does make sense for most people, but you do have to consult with your own financial advisor on that specifically, what percentage you want to allocate. But it does make a lot of sense, especially if the big institutional investors, which we've seen now for a while, they've been coming in, but they're starting to really think about this. Where are they going to allocate? Which part of their portfolio are they going to take and allocate a little bit of it maybe to crypto? And if it's not equity, it's likely going to be, at least in part, the bond portfolios. Again, this is up for a lot of discussion, a lot of debate. Some of you might agree with this, some of you might totally disagree. I want to kind of go sort of introducing you to our thought process and what we think is the upside here, or one of the upside catalysts, and what we're seeing on the institutional side. So I hope this makes sense. Any questions, comments, let us know, and we'll see you in the next video.